coming up on Global Business. Market reforms, new trading rules take effect on Chinese mainland stock exchanges and curb speculation and boost liquidity. EV exports following Canadian Prime Minister Mark Carney's reduced tariff deal earlier this year. Chinese-made electric vehicles entered the country's market in May. We'll assess their reception and uptake. And AI impacts. Will explore whether the AI boom's inflationary effects are a temporary supply chain shock or a lasting trend that will push governments and central banks to adopt smarter fiscal and regulatory policies. Welcome to Global Business. You're watching CGTN. I'm Lee. Our top story. New trading rules took effect across Chinese mainland stock exchanges on Monday, with the Shanghai and Shenzhen bourses seeing the most notable changes. To meet the growing needs of institutional investors, after-hours fixed-price trading, previously limited to the Star Market and Chi-Next, has been expanded to cover all A shares and ETFs in both Shanghai and Shenzhen. Between 15:05 and 15:30, investors are now allowed to trade at the day's closing price. On the main boards, daily price limits for ST and Star ST stocks, those under special treatment for financial or operational risks, have been doubled from 5% to 10%. Analysts say the wider band is expected to improve pricing efficiency and reduce the artificial distortions often caused by narrower caps. Meanwhile, the Shanghai Stock Exchange has replaced continuous bidding with a closing call auction for fund trading. Closing prices are now determined through the call auction process. CGTN spoke with Chen Jiahe, Chief Investment Officer of Nova Market Technologies, to get his take on how the new trading rules will shape the markets in the long run.
One of the most important features of these new trading rules is that they give more time for the trading after 3 o'clock in the afternoon. That means for large funds and institutional investors who have to trade a lot of equities, they will have more time to trade at the fixed price after the regular opening session, which will definitely reduce the fluctuation of prices and make the trading much easier for them. And as a result, will cause less disturbance to the closing price of stocks. Meanwhile, because these new rules are aiming at reducing the fluctuation of prices that could be caused by some details of the old trading rules, that means for the trading department of institutional investors who have a lot of money to handle, the execution and the trading will be easier for them. To understand the relation between market efficiency and the extra earning made by the quant funds, we have to know how the funds are making their money. They make their money because the market makes mistakes. They make their money because there is arbitrage opportunities, because the price fluctuation and the market volatility are large enough for the quant programs to grab the smaller opportunities that can hardly be grabbed by human traders. When the market is more smooth with these new rules, when the price fluctuation becomes less and the rule of the market becomes more clear, the advantage will go to the long-term value investors. And for the quant funds and the speculators who are aiming at grabbing opportunities at short term, they will find the situation to be more difficult under these new rules.
China's central bank injected a net 49.5 billion yuan, or $7.3 billion into the banking system on Monday through open market operations. The People's Bank of China conducted a 7-day reverse repo worth 7 billion yuan and a 1 trillion yuan buyback reverse repo, fully meeting demand from primary dealers. The operations came as 157.5 billion yuan of 7-day reverse repos and 800 billion yuan of buyback reverse repos matured. Liquidity conditions have eased, with the overnight Shibor, a key interbank lending rate, falling to 1.369% and the 7-day Shibor to 1.39%. Analysts expect funding to remain broadly loose in the near term, as seasonal factors and government bond supply are not seen as major drains on liquidity. Moving on now to some other headlines we're tracking for you across China. The country's logistics sector continued to expand in June 2026, with the Logistics Business Activity Index coming in at 50.6%, up 0.3 percentage points from May. Demand rose steadily in sectors including electronic machinery, telecom equipment and transportation manufacturing, while fixed asset investment in logistics also picked up. Chinese robot exports totaled 19.99 billion yuan, or and $2.9 billion in the first 5 months of the year, with 10.4 million units shipped to more than 150 countries and regions, led by the EU and ASEAN. Cleaning robots dominated the category, accounting for more than 70% of total export value, while industrial robots and smart bionic robots also posted notable gains. And China exported 2,637 ships worth of more than 170 billion yuan in the first 5 months, up 22.5% year on year. Among them, liquid cargo vessels exports surged 188.8% in value to 64.3 billion yuan, with units rising 67% to 187 vessels. In Beijing, every square metre counts. Now, spaces that once went unnoticed are drawing fresh attention. The city is no stranger to world-famous landmarks, but increasingly visitors and locals alike are looking for something beyond the usual sightseeing, and they're finding it one floor up. Our reporter Yu Bo-kun takes us to the rooftops.
Everyone knows Beijing from the street. The bustle, the traffic, the crowd. But these days, more people are heading one floor up. This old bookstore has stood in central Beijing for decades. Locals drop by for coffee, reading, or a quiet break. The owner renovated a few years ago to make room for more readers.
Our bookstore was quite small. During a 2023 renovation, we added a rooftop terrace, expanding the space from 130 to 260 square meters.
Well, hidden in the Beijing is one of the busiest neighborhoods. This bookstore has found an unexpected draw. Its second-floor terrace.
The terrace now hosts reading sessions, flower arranging workshops, and small events, attracting a whole new crowd.
With the breeze outside, you feel much closer to nature.
It's definitely a different atmosphere from being inside. Sitting here and looking out at the historic buildings just feels wonderful.
Today, the rooftop is just as popular as the shelves below.
The Dongcheng government's campaign to promote terrace businesses has brought in customers who come specifically for the terraces. We've also seen more young visitors.
Beijing's famous landmarks aren't going anywhere, but what's changing now is how the city is using existing spaces, where terraces like that are giving visitors a fresh experiences and while creating new business models for local shops.
The Dongcheng district government has linked more than 300 terrace spaces along the central axis with hotels and tourist sites. Partnerships with platforms like Meituan and Ctrip are helping draw more foot traffic. From bookstores to restaurants, terraces are breathing new life into old spaces. In a city where every square meter counts, even a rooftop can become a destination in its own right. Yu Bo-kun, CGTN, Beijing.
Namibian President Netumbo Nandi-Ndaitwah has arrived in China for a 7-day state visit at the invitation of President Xi Jinping. He touched down in Guangzhou, South China's Guangdong province, on Sunday. His visit comes as Namibia and China seek to build on decades of cooperation in trade, infrastructure, mining and technology. The two sides are also working to implement commitments made at the Forum on China-Africa Cooperation Summit in Beijing in 2024. CGTN's Enoch Sikolia reports.
China and Namibia's diplomatic relationship dates back to March 1990, just days after Namibia gained independence. 35 years later, the two countries have a comprehensive, strategic, cooperative partnership built on mutual respect and shared development goals. Today, China is one of Namibia's most important economic partners. The trade relationship is driven largely by mining, while Chinese exports to Namibia include machinery, manufactured goods, and technology. Beyond trade, Chinese investment has expanded into infrastructure, manufacturing, renewable energy, and mineral beneficiation. Chinese-supported projects, including investments in the Husab and Rosing uranium mines, continue to contribute significantly to employment, tax revenues, and Namibia's economy. President Netumbo Nandi-Ndaitwah's visit to China is expected to deepen cooperation in sectors ranging from agriculture and manufacturing to digital innovation, renewable energy, science and technology. She is scheduled to meet business leaders and visit major manufacturing and innovation centers to explore new investment opportunities aligned with Namibia's industrialization agenda. The latest engagements are expected to further strengthen trade, investment, and people-to-people exchanges as China and Namibia seek new opportunities for shared growth. Enoxikolia, CGTN.
Chinese-made electric vehicles have entered the Canadian market. Data from Global Affairs Canada says May was the first month of EV imports from China. Earlier this year, Canadian Prime Minister Mark Carney signed an initiative with China allowing it to export up to 49,000 Chinese EVs per year into Canada at a reduced tariff rate of 6.1%. Nina de Vries has more from the province of Ontario.
EVs at this car dealership in Mississauga, a city just outside of Toronto, are getting their last inspection before going to their owners. The cars are not from China, but that may soon change. Carnick's dealership has been watching China closely and what they are doing to make a better EV product. And it's strongly considering selling EVs from China, says General Manager Noah Liu.
We're going to evaluate their product values, their product quality, as well as see if they're up to the Canadian market's expectation in terms of price, the most important thing, the price, and also after-sales services. They're critical to the Canadian market.
According to a Reuters report, the U.S. company Tesla has already started bringing Chinese-made vehicles into Canada. And it's expected that Geely, a Chinese brand, will export Lotus EVs to Canada starting this month.
So how do Canadians really feel about Chinese EVs coming here? Well, recent surveys show they're very open to it.
An Auto Pacific survey reveals that over half of Canadian car buyers would consider buying a car made in China. Another poll by Nanos Research Group for Bloomberg News says that 53% of Canadians said it wouldn't affect their buying decision if an EV came from China. And Liu says customers have already been expressing some interest. In terms of how Canada's move to work more with China might further strain relations with the U.S., some experts say it was still a reasonable choice.
So having another partners is something that we had to do. So maybe on a high level, it sours the relationship, but at any deeper level, it's a clear step, it's a clear response.
On the flip side, Professor Barron adds that U.S. lawmakers recently introduced legislation that could prevent Chinese EVs from traveling on U.S. roads. This could have an impact on people who may want to travel to the U.S. from Canada. And when it comes to Canada's auto industry, experts say it's important the cars are manufactured here in Canada.
We want beyond just having access to Chinese cars, we want to have access to, want to make sure that jobs are being created here in manufacturing and research and infrastructure, because the future of the industry certainly isn't in hoping that we'll keep making gas cars in Canada.
Back at Carnex, Liu agrees keeping Canadian jobs is important.
For example, the battery, the after-sale services, the aftermarket parts, there's going to be a huge market for all that as well.
For now, the more specific details on exactly how the cars will be made isn't clear, but Canada wants to make sure it's in the driver's seat. Nina de Vries, CGTN, Mississauga.
As Europe battles record-breaking temperatures, Chinese cooling products from air conditioners and electric fans to high-tech sun umbrellas are flying off the shelves. Beijing is calling on Europe to drop the zero-sum mindset and take a more objective view of bilateral trade.
Products that meet demand and offer good quality at affordable prices are naturally welcomed. The structure of China-Europe trade is a natural result driven by market forces and based on complementary advantages. As facts have shown, in China-Europe trade, consumers have benefited while suppliers have made profits. It's impossible for transactions to be forced. They are based on mutual choice and deliver benefits to both sides. We hope that people on the European side will view China-Europe economic and trade ties objectively, abandon the zero-sum mentality, and work together to make the pie of mutually beneficial cooperation bigger.
You're watching Global Business. When we return. AI impacts. We'll explore whether the AI boom's inflationary effects are a temporary supply chain shock or a lasting trend that will push governments and central banks to adopt smarter fiscal and regulatory policies.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global business. Only on CGTN.
Let's move on now to some other business headlines we're tracking for you this hour. German industrial orders unexpectedly rebounded in May, official data showed Monday. However, the government cautioned that significant headwinds persist, citing geopolitical uncertainty stemming from the ongoing war in the Middle East. Eurozone investor morale rose to 3.1 points in July from 13.4 the month before, that was minus 3.1 points in July from minus 13.4 the month before was the rise there, beating forecasts for a third month. German reforms brightened expectations, turning the economic outlook more positive for the first time since March. And SK Hynix has launched a $28 billion US listing, set to be one of the largest overseas offerings to fund domestic chip plants and EUV gear. Riding the AI boom, the move aims to narrow its valuation gap with Micron. Artificial intelligence is emerging as an unexpected driver of US inflation, as surging demand for chips ripples through the broader economy. The AI boom has tightened global memory supply, raising costs for tech companies and increasingly consumers. Apple and Microsoft earlier announced price increases, citing higher component costs. Bloomberg data shows prices for software and computer accessories rose at 14.5% in May from a year earlier, while analysts estimate the memory shortage could add 0.4 of a percentage point to inflation before easing. Fed Chair Kevin Warsh has acknowledged price pressures but says expanding supply should eventually offset the impacts. IMF economists also say rising tech stock valuations are boosting household wealth, supporting consumer spending and adding to inflationary pressures. For some more on discussions around AI investment and inflation, we're joined by Professor John Gong from the University of International Business and Economics. Good evening, Professor. Thanks for joining us. So AI is increasingly being linked to inflationary pressure. Is this a short-term supply bottleneck as demand outpaces capacity currently, or are we looking at a structural shift that could keep inflation elevated more medium to long term and force the Fed into rate hikes, noting that markets are already pricing in a September rate hike? And more broadly, if I can fit two questions into one, are we in the early stages of an AI-driven asset bubble?
Well, I think this is clearly a sort of a mismatch between demand and supply. There's a temporary shortage of capacities to make chips, to make memories. And the problem is that even this is a short-term demand and supply shock and it's a mismatch. The problem is that the semiconductor cycle is fairly long. It takes a lot of money, a bit of a time to ramp up production, ramp up capacity. People say that in the memory business, for example, it's going to be 3 years ahead that we're going to see an ease of supply in this area, and so that the prices are going to be flying pretty high for the next 2 to 3 years. So to answer your question, it's supposed to be a temporary short-term shock, but due to the nature of the investment in semiconductor business, this thing looks pretty long, 2 or 3 years ahead, and we're going to be stuck in this situation for some time.
So over the past decade, we've seen quite a dramatic reversal in tech leadership. Software and internet giants have lost momentum, while the chip makers and hardware firms have surged, some up to tenfold. Does this mark a fundamental reordering of the tech ecosystem, and should we rethink how we define and value technology in this new cycle?
Yeah, I think so. I mean, there are always those stars in a new age. I mean, this reminds me of the days of the telecom bubble, quite a few years ago, I think in the mid-1990s, and then the dot-com bubble in early 2000s. NASDAQ was very high at the time and then dropped by 50%, more than 50% actually. In those days, there were stars, there are those companies in that wave. Today, it's the AI wave, and clearly, you have these chip companies, memory companies that are shining stars of today's business right now. So I think, usually there's going to be some kind of a structural reshuffling in the tech sector. And clearly we have a new a set of stars in this business right now. And I think it's going to continue for quite a few years.
AI has delivered some extraordinary profits for quite a small group of tech leaders. Consumers are facing higher prices and real wages are lagging. Does this growing imbalance risk triggering political backlash or perhaps regulatory intervention? And if governments do step in, can today's elevated valuations in AI-linked stocks realistically be sustained where they are?
Well, I think it's very clear that today's U.S. economy is very much driven by AI investment, and this tremendous accumulation of wealth towards a set of very few companies, very few people. They are getting a windfall of the AI related profits. But I think the issues probably goes way beyond that. I think it's not just a temporary sort of clustering of profits, due to the demand and supply mismatches I alluded to earlier. I think over the long run, we're probably talking about, continued diminishing returns on labor versus returns on capital. We are starting to see, these machines and the algorithms replacing people, even white-collar people. And that's going to have a profound impact on the job market. And over the long run, I think indeed we're going to see a very, severe school of income level in society. And I'm of the camp that the government should step in and think about these issues over the long run. I think, there are those people in the United States are thinking about this. I think the people, policymakers here in China are thinking about this. Even in the United States as probably the ultimate example of free market economy. I mean, people are talking about, government taking a share of these high-flying AI companies. This is what we call nationalization, right? So, these ideas are not really far-fetched. And I think indeed there's a perspective here that the government should probably step in, at least to take precautionary measures against this drastic, income distribution that is going to be having a severe impact on society and also on, societal stability, in my view.
Professor John Gong, thank you very much for your time and expertise. He is from the University of International Business and Economics. Appreciate your time. The UK Maritime Trade Operations Agency reports that only 70 US escorted merchant ships passed through the Strait of Hormuz in the 72 hours ending July 4, which is well below the pre-conflict average. The Strait of Hormuz has two shipping routes, a southern route under US escort and a northern route controlled by Iran. Figures show a steady decline in daily US escorted traffic from 33 on July 2nd to 29 on July 3rd and just 18 on July 4. The agency has assessed the overall threat level across the strait as elevated. With Iranian surveillance active and naval mines present in the waters, navigation safety remains a serious concern. The Organisation of Petroleum Exporting Countries Plus has met virtually to discuss oil production quotas for August. Any adjustments would follow extreme volatility in global oil prices caused by the war on Iran and the broader Middle East conflict. The United Arab Emirates recently withdrew from OPEC as well as the wider OPEC Plus, ending its 58-year membership. John Gambrell with the Associated Press reports from Dubai.
So far, what analysts have suggested is that OPEC will raise its daily production by 188,000 barrels of crude oil a day. Now, that's not a whole lot, but it is slowly starting to chip away at the reduction it made back in 2023 when it halted about 1.65 1.5 million barrels of oil production per day across the cartel. At the time, that was coming after some concerns in the banking industry. OPEC wanted to try to dial back its production in order to keep prices stable. OPEC long has been trying to say that it's a lever by which to keep the oil market in check, but we have just seen chaotic scenes over the last months because of the Iran war. For a time, the typical price of a barrel of Brent crude was at $120 US, which meant that people around the world, whether they were trying to fill up jet planes or fill up their car at the petrol pump, really were feeling the pain of those prices. Now, recently we have seen Brent drop back down to about $72 a barrel as of Friday, but the market remains pretty volatile, in part because of the concerns over the Strait of Hormuz, through which about a fifth of all oil and natural gas traded once passed in peacetime, and now it's at the center of disputes over trying to reach a permanent end to the Iran war.
As traffic through the Strait of Hormuz resumes, some analysts suggest that the recent output increase is likely more symbolic than substantive. They expect its impact on oil price trends to be limited.
Production losses had already amounted to approximately 12 million barrels per day by May. Although shipping through the strait has shown signs of loosening since late June, the current market is still primarily absorbing inventories that were previously held up at sea, rather than fresh output entering the supply chain. In the near term, therefore, the impact on oil prices should not be overstated.
So you're going to look around the world, and you're already starting to see exploration starting to expand, and that's only going to grow and grow and grow. So a permanent level of geopolitical risk is going to sit on top of oil prices for a period of time. That's likely to be until this regionalization, works its way through.
Analysts also said with the summer travel season now in full swing, crude oil demand has seen some recovery. If the Strait of Hormuz remains open and traffic flows smoothly, the crude oil market could see supply and demand initially move toward a relative balance in the fourth quarter of this year. And that is all we have for this edition of Global Business. I'm Lincoln Humphreys in Beijing. You've been excellent company. Thank you for watching. We'll see you next time. Goodbye for now.